Gold didn't just rise in 2025, it rewrote the rules of the market. Behind the record prices and investor frenzy are a few companies that quietly turned this gold rush into extraordinary gains. And by the end of this video, you'll know exactly who they are and what's coming next. In 2025, Agnico Eagle Mines became one of the world's strongest gold producers. Its stock reached $167.92, climbing 58% in the past 6 months and 105% year-to-date, one of the best performances in the entire gold sector. But the real story wasn't the share price. It was how Agnico quietly transformed its balance sheet and turned operations into a cash machine. At the start of the year, the company's net cash position was roughly neutral. By the second quarter of 2025, Agnico reported $963 million in net cash, and by the third quarter, that number had surged to $2.16 billion, according to company filings. That dramatic shift showed how disciplined operations and cost control can convert strong gold prices into real balance sheet power. In Q3 2025, Agnico reported a realized gold price of $3,476 per ounce and an all-in sustaining cost of $1,373 per ounce. That left a profit margin of more than $2,100 per ounce and produced record free cash flow of $1.19 billion for the quarter, making Agnico one of the most profitable miners in the industry. The company's operations in Canada and Finland gave it the stability every miner wants. No political drama, no supply chain bottlenecks, just efficient production and debt reduction. The result was steady output and record cash generation at a time when volatility ruled the market. Looking ahead to 2026, Agnico's momentum shows no sign of slowing. With gold trading around $4,100 per ounce and costs among the lowest in the sector, analysts expect further dividend growth and continued expansion across the Abitibi Greenstone Belt, one of the most productive gold regions in the world. Agnico Eagle Mines didn't just ride the gold boom. It mastered it. Through discipline, precision, and consistency, the company turned a strong market into a record-breaking year of profitability and growth. In 2025, Barrick Mining Corporation made a strong impression. The stock rose to $34.80, climbing about 91% in the past 6 months. This kind of surge rarely happens without real operational momentum behind it. In the third quarter of 2025, the company produced 829,000 ounces of gold and 55,000 tons of copper. These numbers came directly from their official production report, showing the scale of their output. At the same time, operating cash flow reached $2.4 billion, and free cash flow came in at $1.5 billion for the quarter, both record levels for the company. Barrick's focus on cash generation and portfolio strength also showed up in its investor returns. The company increased its base quarterly dividend by 25% and announced a major share buyback program. Despite a year-on-year drop in gold production, from 943,000 ounces in the third quarter of 2024 to 829,000 in the same quarter of 2025, the realized gold price and margins rose, driving those strong cash results. The company also benefited from its copper business, reinforcing its appeal in the energy transition metal space. The Lumwana copper mine and other assets added diversification, making Barrick more than just a gold-only play. Looking ahead, Barrick has laid out ambitious goals for growth and cash returns. They are targeting significant organic production expansion through 2030, while prioritizing cost control and financial discipline. In short, Barrick's 2025 rally was not just about gold prices. It was about performance and strategy. In 2025, Rio Tinto reached the kind of growth that proves diversification still works. The stock climbed to about 5,304 pence, up around 14% in the past 6 months and roughly 11% year-to-date. While that is quieter than some metal miners' 50 to 100% moves, it was built on solid performance rather than hype. In the third quarter, the company reported that copper equivalent production rose 9% year-on-year, driven by gains across its portfolio. Its copper output alone reached about 204,000 tons, up around 10% from the prior year. At the same time, its Pilbara iron ore shipments reached 84.3 million tons, the second highest third-quarter level since 2019 and up about 6% compared to the second quarter. These production shifts highlight how Rio Tinto leveraged both its long-established strengths and its exposure to energy transition metals at the same time. A key driver was the ramp-up at the Oyu Tolgoi underground mine in Mongolia, which is on track to boost output by more than 50% this year and help tilt the business toward growth metals. Meanwhile, the Pilbara iron ore system remains strong, supported by efficient logistics and disciplined operations despite a challenging global steel market. What sets Rio apart is its dual-engine model: iron ore to generate cash flow, and copper along with other critical minerals to capture the future. In a sector where many companies rely on a single metal, that balance gave Rio Tinto remarkable resilience in 2025. Looking ahead, analysts expect the company to benefit from both industrial recovery and the accelerating energy transition. With copper growth locked in and iron ore volumes holding firm, Rio appears well-positioned, as long as costs stay contained and major new projects remain on track. Rio Tinto's 2025 story is not about chasing a gold rush. It is about scale, consistency, and a multi-commodity strategy. In a year full of volatility and speculation, Rio proved that a well-run, diversified miner can still deliver steady, reliable returns. Quick pause. If you're finding this video helpful, hit that like button. It really helps the channel grow. In 2025, the SPDR Gold Trust emerged as one of the standout vehicles of the gold rally. Its share price rose to $378.38, up about 27% in the past 6 months and roughly 54% year-to-date. These are impressive gains for an exchange-traded fund that simply tracks the price of gold, and they reflect something deeper than just a sharp rise in the metal. On the 22nd of September, 2025, the fund recorded its largest single-day inflow in history, with about $2.2 billion entering in a single session. By late September, total inflows for the year had reached approximately $12.9 billion. The message was clear: large investors were moving into gold, and they were doing it fast. Several factors fueled this surge. Central banks around the world began cutting interest rates, inflation remained stubborn, and geopolitical tensions continued to dominate headlines. In that environment, institutional investors sought safety. Rather than storing bullion themselves, many turned to the SPDR Gold Trust because it offered fast, large-scale exposure to gold without the logistical challenges of handling the physical metal. This flood of capital helped push gold prices to new highs, creating a feedback loop where rising prices attracted even more investors. For those holding shares in the SPDR Gold Trust, 2025 was proof that gold still shines brightest when markets grow uncertain. Looking ahead into 2026, the outlook remains favorable. If global volatility stays elevated and central banks keep their policies loose, funds like the SPDR Gold Trust are well positioned to attract additional inflows. For investors seeking exposure to gold without the complexity of storage or delivery, the SPDR Gold Trust remains one of the most direct paths to institutional-level access to the precious metal. In 2025, the Sprott Physical Gold Trust became one of the most compelling ways to own gold. Its price rose to $31.27, up about 27% in the past 6 months and approximately 53% year-to-date. Strong returns for a fund built entirely around holding real metal. As of the 30th of September 2025, the trust held 3,646,692 ounces of physical gold and reported net assets of $14.11 billion. Over the 9 months ending on the same date, the trust issued 53,985,377 units through its at-the-market program for gross proceeds of $1.3 billion. Investor demand followed a simple logic. When uncertainty rises, many turn to physical bullion rather than derivatives or complex instruments. With gold prices surging and concerns about inflation and geopolitics still lingering, the trust provided exactly what investors wanted: real, tangible gold stored securely in vaults without the complications of buying and storing bars individually. As gold climbed toward its highest levels in years, the value of the trust's holdings grew automatically. Combined with strong inflows and new unit issuance, 2025 became one of the most successful years in the trust's history. Looking ahead to 2026, the trust remains well-positioned for further growth if demand for physically backed gold continues and investors keep favoring tangible assets over paper exposure. When you line up all 5 of these names, the picture of 2025's gold market becomes clear. Agnico Eagle Mines and Barrick Mining Corporation took the spotlight for one reason: execution. Both companies turned higher gold prices into record cash flow while keeping operations tight and efficient. Agnico more than doubled year-to-date, and Barrick delivered nearly a 91% surge in just 6 months. Those numbers were not luck. They were the result of strong management, stable assets, and a clear focus on mining profitability. Then you have Rio Tinto, the steady giant. While the gold miners chased record prices, Rio quietly expanded its copper and iron ore output, proving that diversification can be just as powerful as exposure to precious metals. The company's copper production grew about 9% year-over-year, and its Pilbara iron ore shipments remained near historic highs. With the world pushing for more renewable infrastructure and electric vehicles, Rio's position in both copper and iron ore gave it consistent, reliable growth. On the investment side, the SPDR Gold Trust and the Sprott Physical Gold Trust were the clear winners for capital inflows. SPDR's record-breaking single-day inflow of $2.2 billion in September showed how aggressively institutions were moving into gold. Sprott, on the other hand, became the go-to choice for investors who wanted physical bullion rather than paper exposure, raising more than $1 billion through new unit issuance. Both reflected a simple truth about 2025. Investors wanted safety, and they wanted it fast. Put their 6-month and year-to-date gains next to each other, and the contrast tells the story. Agnico up more than 104%, Barrick up nearly 91%, SPDR and Sprott both around 53%, and Rio holding steady with double-digit gains. Each of them grew for a different reason, but together they represent every layer of this year's gold rush, from miners pulling it out of the ground to funds locking it away in vaults. This combination of production strength, commodity diversification, and massive investor flows proves that in 2025, gold was not just a metal story, it was a money story. Every company found its own way to profit from the same global forces: fear, inflation, and the search for something solid in an uncertain world. Gold enters 2026 trading near record territory, hovering around $4,147 per ounce. That price level represents one of the strongest runs in gold's modern history, driven by central bank buying, persistent inflation pressure, and a widespread shift away from risk assets. The key variables that will determine whether this momentum continues are global interest rates, inflation trends, and central bank activity. If major economies keep rates low while inflation stays stubborn, gold's support above $4,000 appears solid. For mining companies, the focus now shifts to guidance and cost control. Agnico Eagle Mines and Barrick Mining Corporation both are about to end 2025 with strong cash flow and healthier balance sheets. Their challenge in 2026 is protecting those margins if energy costs rise or production growth slows. Investors will be paying close attention to output targets, project updates, and dividend strategies. For funds and trusts, inflows remain the heartbeat of performance. The SPDR Gold Trust recorded its largest inflow ever at $2.2 billion in a single day, while the Sprott Physical Gold Trust expanded its holdings to more than 3.6 million ounces. As long as global uncertainty persists, both funds are expected to continue attracting steady capital from investors seeking safety and stability. At the moment, gold's position above $4,000 gives both miners and funds an exceptional cushion. Producers are benefiting from historically wide profit margins, while exchange-traded funds continue to see strong demand from retail and institutional investors alike. The real question for 2026 is not whether gold will remain valuable, but who will capitalize on it the most. The miners that stay disciplined and the funds that retain investor confidence will shape the next phase of this golden era. Gold isn't just having a good year, it's rewriting history. With prices holding above $4,100 an ounce, mining companies are generating record profits, and investor demand through funds like SPDR and Sprott has reached all-time highs. From Agnico's surge in cash flow to Barrick's production growth, from Rio Tinto's copper strength to massive ETF inflows, 2025 proved one thing: gold remains the anchor when everything else moves. As we move into 2026, the real question isn't whether gold will stay strong. It's who will capitalize on it. This is finance simply explained, and if you want to stay ahead of the next move, make sure you subscribe, like this video.